Hello everyone. This is a Sentic Labcast where I want to talk about our small project on sentiment analysis for climate change, on climate change tweets for sustainable investment. Just talking about the motivation behind our problem. As you know, sustainable finance is becoming increasingly popular. There is a lot of interest and research which goes behind what drives green pricing, green stock pricing, so green assets, for instance. And we want to find whether or not there's a better way of understanding some of the systematic risks associated with green assets and whether or not we can actually build a new model, at least a financial model specific to sustainable finance. And this is actually in the intersection of NLP, which I will talk about later, because we're using NLP to mine some of these textual features and construct them. So just a little bit of the overview of our work. So first thing we want to do is to collect, green and non-green asset returns. So asset returns for green stocks and green equities versus asset returns for non-green entities and like the more brown, more polluting entities. And after that, we want to collect tweets, right? And apply some of the NLP methods on the tweets to derive topic sentiment scores. We want to then regress some of these asset returns on a Pharma French model. So it's a famous financial model, and we want to see whether or not there's an additional alpha change with the inclusion of sentiment scores. And thereafter, we want to examine the coefficients of the new model versus original Pharma French. Yeah, so just describing briefly what the data collection is. Essentially, we have green assets versus non-green assets. So green assets, we collect ETFs as well as a green basket of stocks, so individual stocks alone, where we get 50 stocks from various green sectors, such as energy, green transportation, clean technology, and so on and so forth. And we're doing basically the same for the more heavily polluting stocks such as oil and gas, ETFs, as well as brown basket of stocks, which are 50 stocks from heavy polluting sectors such as coal mining, chemicals, steel and iron, and so on and so forth. Now we want to also collect some of the data that we can use to build automated stock price textual features. First thing we do is we use the Twitter API when it was still available. We queried the keywords climate change from about 2014 to 2022. And we obtained a total of about 400,000 tweets. And thereafterwards, we leverage a paper that we built on previously from Dong, where like they have a labeled tweets data set, which label climate change tweets expertly according to different sentiments and topics. So we have like politics and policy as a topic, mitigation, impact, root cause, so on and so forth, which are different topics. And we also have a sentiment label such as positive, negative, and neutral attached to it. So the idea is whether or not we can use this labeled data set for transfer learning as well as some form of accuracy evaluation. We use Roberta and Distilbert, for instance, where basically we're just training a BERT model on these tweets. We're doing some form of transfer learning for actually doing fine tuning on the subtopics of the topics on the subtopics of each different topic and the sentiment class, for instance. Yeah. So roughly we get about 80% accuracy. So just for appreciation, these are some of the tweets that we have. So you can see the first one, when it comes to climate change, expensive gas is a good thing, makes you think twice about driving anywhere. And this is actually a positive sentiment under the topic of climate change mitigation, yeah, or solutions to sort of like mitigate the harmful effects of climate change and so on and so forth. So the idea is whether or not we can compute maybe some sort of sentiment score where we get like a maybe monthly sentiment score from all of these features that we have, and we want to scale this sentiment score, for instance, and we thereafter regress this sentiment score on some of the asset returns. So a regression actually involves, modifying some of the Fama French by adding a additional sentiment score X here. Yeah, so you can see some of the equation that we did. So there's small minus big, high minus low, which is your typical stock price features. And then we are adding this computed sentiment score that we have to this regression to see whether or not it can account for more alpha, reduce the additional alpha, because if it reduces the additional alpha to a certain extent, it can account for the additional stock returns of this specific basket of green stocks, for instance. So if you have a specific sentiment towards climate change, it might end up accounting for some of the asset returns. Yeah. So obviously, there's a three factor versus a five factor pharma French, and we want to work with a three factor because we do not want a model to be too complex where you essentially have more factors than necessary, which would lead to multicollinearity and things like that. Yeah, so this is just an appreciation of how your sentiment score towards climate change has changed over time. You can see that there is a certain height of negative sentiment and skepticism as time progresses, which is quite interesting as a trend. And then, after we did the regression, we can actually see how the alpha changes. For instance, yeah. So by observing the changes in alpha, we can come to a couple of deductions. So the betas here are actually the coefficients of our regression, where the t-stats is like whether or not our regression is statistically significant, and so on and so forth. So essentially, if you have a lower alpha, which is what we are looking at, we can show to a certain extent for a certain class of stocks, actually climate change sentiments accounts for uh, some of its returns. Yeah, so you can see that beta 4, which is your coefficient of X in our regression, is positive for green aspects. So there's actually a negative for non-green aspects. So there's a positive risk exposure. So you can also see that the alpha decreases for green baskets for tweets. So you can see that in the three-factor regression, alpha was about 0.96, but when we do this regression on a four-factor regression, means with the inclusion of our climate change tweet sentiment, what happens is that the sentiment scores actually decrease. Yeah. So that's only for the green basket. So for the ETFs, we actually see a reversal in the trend. So that's interesting. So because I think it might be due to some of the financial literature about how ETFs are actually priced with more varied interactions in the stock market with different factors. Yeah. So I'm going to say that the results, most of them have a t-value of lesser than 2. So it means that while it might not be statistically significant, they can still be economically significant, which means they can still end up showing some form of influence in the returns, at least for our little case study here. Yeah. So these are just more regression results on the different topics. So when we see that the regression on the climate change scores for mitigation actually shows some interesting results. For these other regressions, we see we don't really see as significant results for green assets. However, we see that for the heavy polluting ETFs, it decreases in the alpha, or yeah, in magnitude, which is actually interesting because I think it shows to a certain extent that maybe this specific model it has less promising uh, to explain, like is less promising to explain non-green assets due to a lower statistical significance, and I think that's why we get a lower alpha. But I mean, for this regression, for instance, it's very hard to make sense of it. It's not very intuitive. Yeah. So the main results that we found uh, is it shows more promise for explaining green assets uh, relative to non-green, and it is economically significant, but it's specifically for the climate change with respect to mitigation tweets. And we're able to get some form of economically significant results, at least in our case study for this specific one case, despite the fact that tweet data might be a little bit noisy. Yeah, so while we aren't able to get results for a whole swath of different uh, climate change topics and things like that, we were able to get some economically significant results for just that one piece. Yeah, so I mean, ideally, for the purpose of this paper, I think it was just a very short study, but I think it sheds light on actually whether or not we can grab like a larger pool of textual data to obtain some form of asset returns. And essentially, when we are able to do that, it's quite a promising tool for practitioners to use because it is automated, it's easily scaled, for instance, and we can let this be a additional source of returns for green assets, for instance, uh, in the future. So for the understanding of green finance and for people to invest sustainably. All right, so thank you.